Hello and welcome to Live Wire Markets. My name is Chris Conway. On today's episode of The Pitch, I'm sitting down with Gabriel Ng. Gabriel is going to talk through the compelling case for adding private equity to portfolios. He is the managing partner of private equity at Neuberger Berman. Gabriel, thanks for joining us on today's episode of The Pitch.
Thanks for having me too, Chris. Pleasure to be here.
Gabriel, big question to start off with. Why should investors consider private equity as an alternative over traditional equities?
Well, that's the golden question. Right. I would say that, I'll break it down into two main reasons. Number one, it's really driven by the higher returns that the asset class has managed to deliver over time. And we're not just looking at 1, 2, or 5-year data. This is data going back 5, 10, 15, 20 years. So over the longer term horizons, private equity has delivered outperformance versus public markets. And that is a very practical reason why investors want the asset class in their portfolio. The second reason is really, comes down to volatility, right? The private equity asset class is generally less volatile if you compare that to the public markets. And this is because the valuations are performed on more of an intrinsic basis every quarter. So with private equity, you see less swings in the portfolio as you compare that to the public market investments. That being said, right, private equity does come with a high level of risk. Investors might access it to a different degree within the portfolio. So whether it's 5, 10, 15, or 20% allocation, that really depends on the underlying investor's appetite on liquidity and risk. But we do believe that it has a role to play in investors' portfolio construction, and that's becoming more evident as we see, right? I think we see a lot more interest in the alternatives and the private markets asset class, and that's something that we're encouraged by.
Gabriel, you talked about it there. It seems like there is indeed a lot more interest in private markets. What are some of the trends behind that growth?
The growth of the private equity market it comes down to investors seeking higher returns. So you have more capital that's coming into the asset class. The second key reason is also, to do with the number of private companies there are in the market. So we do see, directionally, an increasing number of companies choosing to remain private. So that has led to a larger investable universe. And there are several reasons why companies choose to remain private. I think number one, you just don't have that, monthly or quarterly EPS or share price pressures that you need to manage. You're able to take on longer term strategic growth initiatives without, the scrutiny of the public investor base. So that allows you to create more value over the long term. So, with more companies choosing to remain private, I think that has given more opportunities for the private equity asset class to invest into. And last but not least, I would say that, I think companies and founders are also more receptive to taking on capital from private equity investors because they can see the value add that these private equity GPs can bring to the table in helping their companies scale to a different level or to grow and to ultimately increase in valuation. So instead of tapping the public markets for capital funding, they are now more open to taking private capital to fund the next leg of growth for these companies.
How big is the market, Gabriel, for private equity investments, and where's Neuberger Berman finding the most compelling opportunities?
I would say that if we look at it from a transaction value or transaction volumes perspective, in 2023 it's about a 1.5 trillion market, and that is already 30% down from the highs of 2021. But we do believe, that it's more in line with the longer-term average transaction volume. So it's still a very large market. Where are we seeing opportunities? I think we are a diversified private equity investor. We have multiple strategies that we operate. So on the primary investing side, where we see some opportunities now, interesting ones are really on what we call funded primaries, because the fundraising cycle is just taking a lot longer for GPs to raise their funds. Oftentimes, we're able to come into a portfolio that's partially funded, right? So when we're committing to a fund, it might have already 2 to 3 underlying investments that account for 15, 20% of the portfolio construct. So there's a bit more visibility. So that's what we call funded primaries. So we're seeing some opportunities in that space. On the co-investment side, just given the liquidity constraints and banks pulling back from lending, there's been a lot more need for co-investment capital. So we see multiple opportunities on the co-underwrite form of transactions within co-investments, and also these midlife transactions which require a more bespoke solution or capital solution that we were able to provide to our GPs to help the companies take on creative M&A deals or to fund expansion opportunities into a new market. So that's where we're seeing opportunities on the co-invest side. And on the secondary space, there's been a lot of talk about GP-led continuation funds. just because the exit markets have been tough, but sponsors see the ability to continue to grow very high-performing companies for another 4 to 5 years and to continue to compound on that growth. So we're providers of liquidity to move some of these high-performing assets from one fund to a new continuation fund. And that has seen a lot of interesting opportunities come up on our radar screen in the last 6 to 12 months. So it's keeping us busy.
Gabriel, you touched on the risks at the top. Do investors need to take on extra risk to add private equity to their portfolio?
Yes, and I think they're compensated with the higher level of returns that the asset class has generated. But if you look at risk, I think number one, there's leverage, right? Ultimately, some of these deals, or most of these deals, have some form of leverage. So that's one area of risk that investors need to factor into. The second is really illiquidity. Every individual investment is held anywhere from 5 to 7 years, but that's where the value creation comes in. You need that amount of time to grow the earnings, to reposition the company. But once again, that's additional illiquidity that investors have to live with. And last but not least, it's also execution risk, right? I think a lot of the times the private equity sponsors are trying to drive a step change in a business. They might not always get it right. Most of the time they do, right? But there's a level of execution risk when you embark on such initiatives. But at the end of the day, I think the returns will have to stack up, right, for that additional risk that investors are taking on for this asset class.
Gabriel, last one. How has access to private equity changed over the years?
There is a big topic, and I think it's been talked about a lot, this whole democratization of private equity. I think if we look back, it's been an asset class that has only been really accessible to very large institutional investors, but we're encouraged that there are solutions out there that provide exposure to this asset class to other investors, right? And they typically come in the form of semi-liquid fund structures where the underlying strategy is private equity. And I think the goal there is really to solve a lot of the pain points that other investors might face. Smaller ticket sizes to access, we're solving for that. Single capital call, right? Monthly subscriptions and redemptions. So I think overall it does lead to a greater access to the private equity asset class. But there are also different forms and different underlying versions of these evergreen structures. Right, I think some of them might be single GP type, semi-liquid offerings. Some of them might be a bit more diversified across different GPs. Some of them might, do a bit more primaries, secondaries. Some are more weighted towards co-invest and secondaries. So, I think for the investor out there, education is very important. I think you need to know what you're stepping into, right, and to be comfortable that it's the right risk profile that you're willing to undertake. And for operators of these semi-liquid funds, I think having the right infrastructure, right, to manage a large investor base, to be able to, manage the liquidity, right? I think all that is very important, in addition to, of course, the core business of generating returns. So yeah, I think it's a good development, and I think it's only going to continue to grow going forward.
Sounds exciting. Gabriel, thank you so much for sitting down with Livewire.
Thanks for having me.
If you enjoyed that episode of The Pitch, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.